What's up, everybody? The most frequent question I get asked these days when it comes to real estate is, what do I think is going to happen to home prices in 2023? Will they continue to correct? Will they crash completely? Or maybe prices will continue to appreciate even just a little due to the lack of inventory? And although the answer will differ depending on where you live, because real estate is very localized, in this latest issue of Fortune magazine, Lambert will show us 5 charts that will give us some clues as to where home prices are headed in 2023. So let's take a look and see what they say. Let's just dive right in. As we all know, since interest rates started going up, prices started coming down. In fact, it was after 124 consecutive months of prices rising between February of 2012 and June of 2022 that prices started correcting, ending with the last 3 consecutive months of price decline. So while it's pretty obvious that prices have started to deflate, a lot of industry insiders still can't agree on the future of home prices due to a lack of inventory. Traditionally, if there isn't a lot of inventory, then the demand on the homes that do come on the market will be high, thus causing prices to stay high. Makes sense, right? If there is one good thing and 3 people want it, those 3 will compete for it, thus raising its value. But the housing situation today is different. We may not have a lot of inventory, but demand is way down as well. Lambert writes that mortgage purchase applications are down 38% year over year, currently just below their lowest point during the 2000s housing crash. Now, if interest rates go down in 2023, this may change as homebuyer demand increases. And as for inventory, Lambert writes that new listings on Realtor.com are down 17.25% on a year-over-year basis, but inventory levels are currently up 46.8% year-over-year. Basically, potential sellers who then also want to buy are choosing to stay in their homes with their low interest rates rather than sell their homes and buy a new home with a much higher rate. So how is inventory so high but new listings on the market so low?
Why is that, Pop?
Well, that's easy. Homes are just sitting on the market a lot longer because demand is the lowest it's been in a long time. Let's take a closer look at inventory data in the nation's 400 largest markets with this first chart provided by Lambert and Fortune. This map shows how inventory levels have shifted over the last 12 months from November 2021 to November 2022. While national inventory levels are up 46.8% according to Realtor.com year over year, this will change significantly depending on the market. Cities like Austin and Phoenix have seen their inventory levels go up 160.7% and 176% respectively, while markets like Chicago and New York City remain essentially unchanged. This is a huge difference. Back in the housing crash of 2008, we had a huge influx of inventory across the entire country due to subprime lending practices, which affected all of the buyers who could no longer afford to pay the mortgage regardless of what market they were in. I mean, it seems like the markets that boomed the most these past 2 years are also the ones that are correcting the fastest. Lambert writes that when it comes to inventory, the speed of change matters. A sudden inventory spike often marks a housing market that has moved into a full-blown correction. And that's what's happened this summer in markets like Austin and Phoenix, where home values are already down 10.4% and 8.1% from their respective 2022 peaks. Check out his next chart. Here you can see the percentage overvalued or undervalued as calculated by Moody's Analytics, with the percentage change in inventory on Realtor.com between November 2021 and November 2022. Every quarter, Moody's Analytics assesses whether local fundamentals, including local income levels, can support local house prices. If a regional housing market is overvalued by more than 25%, Moody's Analytics deems it significantly overvalued. Lambert writes that the influx of high-earning remote workers saw home prices in boomtowns like Boise and Idaho Falls detach from local income. According to Moody's Analytics, Boise is overvalued by 74%. But what happens when remote worker migration slows down and interest rates go up dramatically? You're left with locals who are just not going to be able able to afford to buy a house. So inventory sits on the market longer and longer, and ultimately prices will begin to fall. But not everybody thinks that prices are going to continue to go down. Some firms like CoreLogic and Home LLC doubt that U.S. home prices will fall in 2023 with inventory being this tight. Researchers at Morgan Stanley say that those housing bulls should reconsider their stance. The fact that we expect home prices to start falling on an annual basis in March 2023, despite tight inventory, reflects how unprecedented this affordability situation is in the U.S. housing market, writes Morgan Stanley researchers, who expect U.S. home prices to decline around 10% from peak to trough, even though supply remains below 6 months of inventory. In November of 2022, there were 751,544 active listings. That's up from 511,899 active listings in November of 2021 and 683,606 active listings in November of 2020. However, the number still remains way below the pre-pandemic active listing count of 1.14 million in November of 2019. So in order for prices to fall with such low inventory, does demand have to drop even lower than the supply? Rick Palacios Jr., the director of research at Johns Burns Consulting, tells Fortune, when demand abruptly falls off a cliff, the absolute level of supply isn't as relevant. This is where watching the rate of change on both supply and demand separately is critical. He goes on to say that investors accounted for the highest percentage of buyers ever in this housing cycle in many markets, as well as builders accounting for roughly twice their historical market share, both of which don't value home prices like a traditional owner would, and will drop their prices much faster just to offload their inventory. In terms of national home prices, Johns Burns Real Estate Consulting expects a 20 to 22% peak to trough price decline if affordability remains hampered by 6% mortgage interest rates next year. Keep in mind, whenever a group like Morgan Stanley or Johns Burns Real Estate Consulting says U.S. home prices, they're talking about a national aggregate. Obviously, this will vary market to market. Lambert's next chart shows 36 housing markets that are back to pre-pandemic inventory levels. Using Austin as an example, you can see the 8,339 in November of 2022 is higher than the 6,907 of November of 2019. I'll put a link below with the chart in case you want to see the other 35 markets. In theory, the higher inventory levels could push home prices down in those markets. And finally, Lambert's fifth chart shows the 364 housing markets that remain below pre-pandemic inventory levels. Where I am in the DC area is one of them, with 10,342 units in November of 2022 compared to 13,877 units in November of 2019. Like I said, I'll put the link below so you can see if your market is included in this list. While Morgan Stanley researchers don't think that tight inventory will prevent home price declines, they do believe that tight inventory levels will prevent a 2008 style crash. Although supply doesn't keep home price growth floored at zero, we do believe it prevents home price declines from becoming too large, writes Morgan Stanley researchers. So what's the bottom line? The more inventory you have, with buyer demand so low due to high interest rates, the more likely prices are going to come down. And the more overvalued the market, the quicker prices will fall. But unlike traditional markets, low inventory doesn't necessarily equate high prices, especially if you add in builders and investors who can manipulate home prices faster by offloading their inventory at a discounted rate to minimize their losses. So with all of the industry insiders' contradictory predictions on the future of the housing market for 2023 in regards to home prices, the only thing that I think that we can all agree on and count on is that the market will continue to correct. So if you are thinking of buying or selling next year, please make sure you consult with a local real estate agent so they can tell you what's going on in your specific market. Because as we've seen, it can really vary market to market. I hope you got some value out of today's video. It's a lot of work putting these together, but I do think it's super important to give you the most up-to-date information so you can make the best decisions for you and your family. If you want to see other housing market predictions, definitely check out some of our other videos as they all come from different sources. I wish you all a very very happy new year. Today is the last day of 2022. I thank you for your support for me and my channel. And if you do want to show some more support, definitely smash that like button, comment below, and subscribe to our channel. It just motivates us to make more videos. And I will see you next year. Bye!